All right, so welcome to the very first class for the financial management paper. Today we are going to do some introductory stuff, right? Trying to understand the environment for financial management, what it is all about. We'll take a look at the economic environment, the regulatory environment, and how that borders around the financial system, right, with respect to Ghana. Okay, so that is what we will be looking at, and some other issues that are very important. Now, like I said, whatever we are going to treat or do takes its foundation from the syllabus. Okay, everything is from the syllabus. So what we are going to treat today is basically what we have here, right? The introductory stuff. And all of the things here will form part of the 5-mark area that we have here. That is basically what we are going to do. Okay. All right. So let's take a deep dive into the key issues. When it comes to this FM paper, like I shared with you in our introductory session, you have to take the position of a financial manager, right? Or a finance officer. So you ask yourself, what does the financial manager do in their day-to-day job? Okay, or what are the responsibilities of the finance manager? And once you're able to understand that, you are going to see that that is basically what the entire paper is about. So for the finance manager, we are saying your work revolves around 5 key areas, right? And what are these areas? One, your ability to raise finance for the company. And so, as we are going to learn later, there are different sources of finance, short and long term. But the text here focuses on what? The long-term finance. So if you're a financial manager, your job is to look for funds for the company and mediums through which you can raise these monies. And so typically they'll be from equity sources, right, through the issuance of shares and other equity sources, and then also debt finance, which will be through the issuance of what? Of debt finance, like bonds and all of those things, debenture, what have you. Again, your job as a financial manager will revolve around what? Making investment decisions. And when we talk about making investment decisions, these are capital projects which you are going to employ the money that you have raised here. Let's say you've raised the money here. You are going to put it into what? Into use, into projects which will then yield the company more return into the future. Okay, so investment decisions, very important. And so aside investing in capital projects, you could even acquire another company. Okay, and that will help to accelerate the company's growth, right? All of these are very important roles that the financial manager will have to play. Thirdly, managing the company's working capital. And that basically is very crucial because working capital is the lifeblood of the company, right? Working capital is the lifeblood of the company. If you are able to manage the company's working capital very well, we are saying this company will continue to operate for a very long time. My screen is not showing. Let me. I hope you can see it now. Okay. Right. So when you're able to manage the company's working capital very well, you keep the company afloat. It is not profit that we always want to make. Profit does not actually mean the company has that amount of money sitting in their bank, right? It is the cash, the day-to-day cash that you need for your operation That is what is most important. And managing working capital helps you to do that just well. So when we get to working capital management, we are going to expand more on that. Okay. The reason why the financial manager will have to manage the company's working capital effectively. And we are going to look at all the elements of the working capital and how to manage them. Then another role that the financial manager will have to play is to manage the risk of the company. And specifically, what we call the foreign exchange risk, and then the interest rate risk. Okay, so that is very, very important, right, for the business, especially if your company is one that deals in foreign currency or deals with counterparties or other parties who are outside the source of your home country. That will mean that the trade between these two parties will involve some form of foreign currency. And if exchange rates, as we know, do not stay fixed, but they fluctuate, then it will give rise to exchange rate risks. And then you should be able to manage them as the financial manager. Again, interest rates, the movement in interest rate also poses some risk to the company, especially if they have borrowed money. If the cost of finance, like we are seeing, is going to change as a result of changes in the exchange rate, in the interest rate, then that again is going to affect the cost that the company will have to pay at the end of the day for raising the finance. So how we manage the interest rates is also very crucial. Rosina is saying she can't see my screen. Please, Ernest, Richard, can you see my screen?
I can see it now. Thank you.
You can see it now. Okay. I think you left and joined. Okay. So that's fine. Okay. So again, we are talking about the roles of the financial manager. Also, the financial manager will have to take dividend decisions. The decision as to whether out of the profits that we have made, whether we should pay everything out as dividend to our shareholders, or whether we should pay a part and retain a part of it, or we should retain everything, right? So all of those decisions, the financial manager will have to take it. And at the end of the day, we are saying whether they pay out dividends or they retain the money out as cash, it should be in the best interest of of the owners who are the shareholders of the company. Okay, and we are going to learn that through the computation of what we call the total shareholder return. Okay, the total shareholder return. All right. So if you have MTN shares, I believe yesterday you should have received dividends from MTN. Okay, so MTN will pay you dividend for the shares you have bought in the company, as well as you are going to enjoy what we call capital gain. That is, if the share price increases, you are going to enjoy capital gain. However, if the share price falls, that will be capital loss. But you truly do not lose the money until you decide to sell. Okay, you decide to sell your shares when the share price falls down. That is only when you lose. But if your money is still there, or your shares are still intact, you stand a chance of seeing an appreciation in the shares of the company, and that will represent capital gain. So as the financial manager, right, they on that side will have to make or take dividend decisions that will affect shareholders. Okay, and if you're a financial manager for your company, these are some of the things that you need to be aware of. All right. We are trying to understand the role of the financial manager, especially within our company. Let's call our company Great Professional Company, right? And so if you are the financial manager for Great Professional Company, we are saying, what are some of the financial objectives that Great Professional Company would want to achieve, the financial ones? Definitely, the shareholders who have given Great Professional Company money, okay, to use in running their operations would expect that you maximize the money that they've given to you. Nobody gives money out for free. Okay? And so one of the financial objectives of any firm is shareholder wealth maximization. And we are saying that that can be what? Computed by looking at what we call the total shareholder return. We have a short example that we are going to solve very, very soon. Okay? All right. So we are saying the main corporate objective is the maximization of shareholder wealth. And that is taken as maximizing the market value of the company. Shareholder wealth is increased by dividend payments or a higher share price. Corporate strategies are therefore desirable if they result in higher dividends and what? A higher share price or both. So total shareholder return comes in the form of these two words, these two things that I've spoken about. Paying your shareholders dividend or ensuring that the company is performing well so that the company's share price will rise. I hope that is clear. And then secondly, one of the financial objectives of the company is what? Will be to maximize company's profit. Now, the profit is maximized, best believe that it is from that same profit that you again pay shareholders their dividend. Okay, so at the end of the day, all of these things will yield to what, or should yield to the benefit of the people who provided you with the finance, and that is what? The shareholders. All right, so let's look at how total shareholder return is calculated. Okay, it's a very simple and short computation we are going to do. Okay, so that we get to understand what that means mathematically. Okay, so let me switch to my worksheet so that we can have access to. Okay. So the questions should load by now. So we have total shareholder return, right? And please, this thing you can be asked to calculate it. In very recent times, I think somewhere 2024, one of the diets, the examiner asked students to calculate total shareholder return. Okay, so let's learn how to do the computation of this. It's very, very straightforward and simple. Okay, I think it has come to forever. Okay, so we have some 3 questions, right, to help us go through that. So remember, we said maximizing shareholder wealth, and then shareholder wealth, okay, shareholder wealth maximization. And I'm saying, or the text is saying that that can be done through what? Dividend payment, and or capital appreciation. So remember, the company's share price does not always rise. Sometimes it falls. Okay, so I'll say capital gain or loss, right? Whatever it may be. We are looking at the gain side. That is what we mean by maximizing shareholder wealth. Now, it could be either paying higher dividends or increasing the company's share price, or a combination of the two. Now, if we are looking at the two, then that will give us what we call what? The total shareholder return. Okay, so it is basically looking at what? Bringing together the two. And the formula is simple. So look at what I'm trying to do here. It is what we call the dividend yield. Okay, so trying to look at the dividend payments in a percentage form, right? That is how I explain it. So that is the dividend yield plus what we call what? The capital gain or loss. Okay. All right, so let me rather say this. This will be share price appreciation. Okay. So share price appreciation. All right. So how do we compute the dividend yield? There's a formula for it. That is going to be the current dividend over the current share price. Okay, so DO is the current dividend, PO is the current share price. All right. So this is one side. Then, kindly hold on for me. Okay. All right. So when it comes to the capital gain, so let's see the capital gain, right? We are saying we expect the price of our share at the end of, let's say, a particular period to be higher than what the price of the share was at the beginning of the year. Okay, so if January 2026, great professional college or great professional companies share price is 2 CD per share, and at December 2026, the company's share price is now at 5 CDs per share, then that represents what? A capital gain. Okay, or a share price appreciation. So that is a capital gain. So to check whether we have gotten a capital gain or not, or a loss, then that will be what? P1. So P1 will represent closing share price, or the share price at the end of the year, right? Minus P naught, which is the current. So current is like, let's say today or at the beginning of the period. So let me change this one and do this, the opening, right? The opening share price or the beginning share price. Okay, so at the end and at what? At the beginning. So P1 minus P naught over what? P naught. Okay, we write it this way, P naught. Right. So this represents what? Either the capital gain or loss. So you add the two, then you get what? The total shareholder return. And that is how we measure what? Shareholder wealth maximization. That is basically it. All right. So we have some 3 questions here, which I want us to go through. Okay, very simple. Okay, so it says the share price of XYZ PLC at first January was 4.8 CDs per share. During the year, a dividend of 20 pesos. Another thing, if you see something like this, 0.2, right? And the currency sign here is the CD, right? 0.2 CDs is more or less the higher denomination of what we will say 20 pesos. Okay, CD is the higher denomination and peso is our lower denomination in Ghana. When you take the dollar, the US dollar is the higher denomination, and then the cent, okay, is the lower denomination. When you take the pound, The higher denomination is what? The pound sterling, and the lower denomination is what? Is the pence. So if you see 0.2 cedis, it means that the money is represented in the higher denomination. This can be translated into the lower denomination by what? Multiplying by what? By 100. So 0.2 cedis, if you multiply by 100, will give you what? 20 pesos. Okay, 20 pesos. So if you want to change pesos into cedis, you divide. If you want to change cedis into pesos, you multiply. So you divide by 100, you multiply by 100. All right. Since whatever we are working with is in cedis, we will maintain it like this. Okay, right. And then it says that, and the share price at the end of the year was what? 5 CD, 10 pesos. And so we should calculate the total shareholder return over the year. And so the TSR will therefore be equal to, we have the formula there already. So the dividend, which is 0.2 over the current price, or the opening price, which is what? 4.8, plus, okay. But again, let me be quick to add that, you see, since the two are adding up together, right? The common factor, which is the denominator, is what? Is P0. So we can bring down or summarize this formula such that our total shareholder return will be D0 plus P1 minus P0 all over what? P0. Okay. And this will give us what? The total shareholder return. So I want to use this one to calculate the same thing we are having here. Okay. So we have the dividend per share at the top plus the supposed capital appreciation, which is 5.1, which is the share price at the end of the year, minus 4.8, which is the share price at the beginning. Okay. Then we divide over what? The opening share price, which is 4.8. Whatever we get, we multiply by 100, because the total shareholder return is a percentage. What will this give us?
So 0.1.
0.1 exactly. Is it 0.1 exactly? Or there's something else? All right. I'm getting, so
10,
in percentage terms,
10.40.
10.42%. Okay, 10.42%. All right. So to the shareholder, this is the return. This is what they are getting on their investment, or the shares that they bought in the company. When you accumulate the dividend they are enjoying, plus what? The capital appreciation. This is the return to them. 10% return on their investment. All right. Let's look at the second one. Also quite straightforward. Okay. It says that the share price of PQR PLC as 1st January is 6.25. During the year, a dividend of 0.5 pesos was paid. And the share price at the end of the year is 6.4. Calculate the total shareholder return. So TSR will be equal to the dividend for the period, which is 0.5. Okay. Plus, here I believe there is a capital loss. Why? Because the share price at the end of the period is quite lower than what we started the year with. Okay, and it happens. So we'll have 6.4 minus what? 6.5. All over 6.5 by 100. And that gives us what?
6.15%.
Okay, so 6.15%. Okay, so very important. All right. So there's a return to the shareholder for their or on their investment. Now let's look at another question, finally, which is a bit trickier than the first two we have looked at. So HCO's share price is 3.5 at the end of 20x1, right? So this I think will be our P1, right? So that is 3.5. And this P1 or the share price at the end of the period includes a capital gain of 0.75 cedis per share. So we represented the capital gain as P1 minus what? P0. Okay, this. And in money terms, we are saying that is what? 0.75 cedis per share. I hope you follow. And this has been so since the beginning of the period. A dividend of 0.25 has been paid for 20x1. So D0 is what? 0.25 cedis per share. What is the total shareholder return in one decimal place? So TSR will be equal to D0, which is 0.25 plus, we are being told, so you see, P1 minus P0 is the capital gain, right? And that is 0.75. So we have 0.75 as the capital gain. However, we were not told what the share price was at the beginning, but we know what the share price is at the end of the period. And we are being told that included in that share price was a capital gain. So it means that from the beginning of the year till the end, we believe whatever the share price was at the beginning, there has been an addition in terms of what this capital gain, and that has resulted in that final share price we are having at the end of the year as 3.5. And so if we want what the share price was at the beginning of the year before we got the capital gain of 0.75, then it means that P0 or P0 will be equal to P1, which is the share price at the end of the period, minus what? The capital gain. Okay, the capital gain. And that will be 3.5 minus what? 0.75. And that gives us I'm getting 2.75. 0 point something.
So no, the total was what I was mentioning.
Oh, you are mentioning the total. All right. So we have 2.75. All right. So at the end of the day, okay, 0 is in percentage. So give me the percentage.
0.36. So it will be 36.36%.
36. It says one decimal place.
36.4.
36.4.
Okay, 4.
Okay, 0.4%. Please. Some of these things, they are small. When you do 36.36%, you may be marked wrong because the question says leave it in one decimal place. Okay, so that is what we have. And so this is the return to the shareholder. I hope that is clear. All right. This is as complex as it can get. Okay, and everything else should be very straightforward for you if you are asked. All right. So we have to understand that a part of the financial objectives of any company will be to maximize shareholder return. And we have seen how to compute that. Profit maximization, I think we have also spoken about, so very, very important. Now, how do we check or know whether we have been able to achieve our corporate objectives, whether it being financial or non-financial? When it comes to the financial objectives, one of which we just saw as being what? The total shareholder return. We've learned how to calculate it, right? Secondly, we could use what? Financial ratio analysis. Okay, financial ratio analysis to be able to what? Compare the company's performance with respect to what? Its profitability. So in computing or checking whether the company has been able to maximize their profit, you can be able to what? Use ratios and compare your profitability from one period to the other. I hope that is clear. All right. So you can compare your own performance over a number of years, or you can compare what? The company's performance to a similar company, or you can compare it to what? Industry averages. Okay. And this gives you an idea of whether you are doing well financially or not. When it comes to the ratios, we have 4 key ratios, and we are not going to do that right now, but there's an aspect that we're going to get to where we are going to calculate these ratios. So we have profitability and return ratios, we have debt and gearing ratios, we have liquidity and working capital ratios, and we have investor ratios. So we are going to do all of these when the time is due. For working capital and liquidity ratios, we are going to treat it when we get towards working capital management. Okay, but aside this, we are going to look at these 3 key ratios when the time is due. All right. Now, it has become very important in this day and age that companies do not only focus on what? The financial aspects of their business, that is to maximize shareholder wealth, to make more profit, and so on and so forth. We have other aspects of the business also that they should what? Pay key attention to. And if you are doing other courses or other papers, the balance scorecard, right, gives you an idea of the other areas which the company will have to what? Avert their attention to. So on the balance scorecard, you are clearly going to see the financial perspective, which is mainly the financial objective of the firm. However, you have other issues with respect to what? Customers, right, who are other stakeholders, the employees, right, through innovation and learning, right, internal business processes, and so many other aspects. So when it comes to a company, the non-financial objectives that we should set for ourselves to try to achieve would include paying our workers very well. Okay? Happy staff will mean, or well-paid staff will mean they are going to be happy, and then they are going to give up their best. And by giving up their best, that will translate into good performance for the company. So we need to pay our workers well. 2, invest in staff training. Okay? So training and learning. You will have to ensure that your workers are very efficient with what they do, and that will come from training and retraining them. Once they are highly skilled, they become very efficient and are able to work very fast. And working very fast is also another way that you can improve upon your performance as a company. And then finally, we also need to look at what? The needs of society and the need to preserve the environment. So these are other aspects of the company which are also very crucial, but do not necessarily have to do with what? Maximizing the company's finances. But one thing again is that if you're able to treat the society very well, if you're also able to preserve the environment, it puts you in a certain or it gives you a certain picture that says that, oh, this company thinks about the environment. This company thinks about the customers. It thinks about society. And so it even makes your product attractive to people. Okay? And so at the end of the day, some of these non-financial things that we are talking about will also reflect in your revenue as a firm. So they are also very, 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 very important. If you have a bad publicity as a company whose operations affect the environment, people may not buy from you again. And in other places in the world, if there's bad news about your company, expect that your share price will start falling very quickly. Okay, very, very quickly. So the non-financial objectives too are very, very important that a business takes consideration of. All right. I did mention in that earlier lecture we did on Tuesday that for the current FM paper, not only are we interested in the commercial setting, but also we need to look at what public sector issues or financial management in the public sector. But we first of all need to understand how the public sector is also structured. So we are what public sector organizations, and we need to know why they are where they are and what their key objectives are. For the commercial company or private companies, we've learned that they have financial objectives and what? And non-financial objectives. For public sector companies, what are they here to do? We are saying these are companies which are not owned by just some shareholders, but they are what? Publicly owned and operated. So it's for all citizens. They are not privately owned and operated. Public sector entities are without private individual shareholders. Interest in public sector entities is held by the state on behalf of the citizens. So we all own a stake in what? In the government machinery. Although we may not benefit directly, we have a part to play when it comes to its operations. Public sector institutions will include the national government, right? That's the central government, the ministries of the government, the departments and agencies, local government institutions like the MMDAs, international government organizations, and commercial public sector entities, which we call the SOEs, right? The SOEs. Public sector organizations, we are saying, will differ from private companies in a number of significant ways. And that is basically because of what? The objective of public sector entities. They operate with the absence of what? Of making profits. They operate with the absence or the motive of what? Making profits. I hope that is clear. Whereas for private companies, as we have seen, they are there to make profit. So if public sector entities are not there to make profit, then what are their key objectives or why do they exist? We are saying they exist to be able to provide public goods and services for all citizens, regardless of their ability to pay for them. If some services like security and let's say roads, right, or some very key public infrastructure was vested in private entities, then we may not be able to pay for it at all. Believe you me, right? But since it is in the hands of the government or in the hands of the public sector, we are able to access some of these facilities or some of these things, regardless of whichever class of society we fall in. Okay, so that is basically so. The government organizations or the public sector organizations are keenly operating towards to provide these public goods, which they only can provide. So basic education, primary healthcare, general security, access to motorable road network. Also, to provide public goods and services where such can only be economically provided for the whole of the citizenry by a centrally planned organization. There are some services that if the private man says they are going to render those services, again, nobody can be able to pay for it, or it's going to be practically expensive. But for issues like protection against external aggression, justice and equity, internal peace, security, and order, the government has enough resources to be able to fund these operations. So our brothers and sisters in the army or in the security services, they are doing a very good job, right? And their services are being paid for by the government. A private person will not find such an endeavor profitable enough, right? Sometimes we don't have any war, but again, they are being paid because we don't know when the US will turn against us, right? Like they are doing in Iran. We don't know when they are going to do that. So basically, such services can only be paid for by the public sector. So it is one of their key objectives. Again, to create and maintain an economic and social infrastructure within the country and to provide a benefit to everyone within socially acceptable norms. Okay, so provision of social and economic infrastructure, very, very crucial. And then also to correct inequalities that may exist among different groups of people within the country. They level the playing ground. Okay, so we spoke about education, access to motorable roads, security, and so on and so forth. Everybody will have access to these things. Water, okay, water. So if the public sector is not in this space, some of these things will be very difficult for almost all of us to be able to have access to. And so they are playing a very critical role in that regard. All right. Please, is there any question that you want to ask? Any question? Oh, I believe these things are quite straightforward for us to understand. Okay. All right. Now, let's go back to the private sector or the private company. I did explain that in today's day and age, it would be suicidal for any company to only focus on only one stakeholder, and which is the shareholders, right, or the owners of the company. It will be suicidal for you to do that. Why? Because a company has more than one stakeholder. We are not only focused on shareholders. You have employees, you have the society, you have the government, you have your suppliers, you have other providers of finance to your company, and so on and so forth. All of these stakeholders want something from your company. They have an interest, okay? And that is the reason why we call them stakeholders of your company. But we are saying that sometimes the interest or what they want from the company may be in conflict with what other stakeholders within the same company or even outside of it will want. Okay, and that is the area that we are going to talk about. And so I believe we have an idea of some of these things already, right? Who the stakeholders are. For the internal stakeholders, we have the company's employees. What do they want? Good salaries, the ability for them to grow within the company, okay, or prospect for rising through the ranks. That's what they want. Companies managers, those who manage the company's day-to-day operations, what do they want? They also are looking out for their careers, income, and personal wealth, okay, that they are going to get from the company. That is what they expect from the company. Who are those connected? So the connected stakeholders, these are people who are connected to the company economically, right? There's something they are getting from the company money-wise. Shareholders, number one. We've mentioned what they want. They want you to maximize their wealth, right? Customers, what do they want? They are interested in what you are producing. They give you money. And so if what you are producing doesn't align with what they want or it doesn't meet their threshold, okay, definitely they may not purchase it or they may not buy it. So they are very, very crucial. When they boycott your product, believe you me, it is going to hit your pocket. Suppliers, what do they want? They provide you with what? Your key material input. So especially if that supplier provides you with more or less, let's say 80% of your material input, then they are very powerful and can influence your company's ability to be successful, right? If they say, hey, we are not going to supply you again, that would be That's going to create a gap in what? In your operations. A huge gap. Okay. So very, very critical. Finance providers, and here we are interested in what? The debt holders, right? Or the debt finance providers. For these people, the only connection they have with you, that's why we call them the connected stakeholder. Connected stakeholders is the money that they are giving to you, right? For you to use to run your business. At the end of the day, you should pay them their return, and that comes in the form of what? Interest or finance cost. So they are looking out for your ability to what? To pay them this return as and when what? As and when due. Okay, so that is basically also what they want. So you can see that all of these people, in one way or the other, they are tied to the company what? Economically. Sikasem. Okay, in one way or the other. All right. Then we have those who are external. We have the government. Okay, and what are they interested in? You abiding by all laws and regulations. And by abiding by all laws and regulations will mean that fulfilling a statutory obligation, which is what? Paying your taxes. Okay, that is what the government wants. The company, the community at large, they're interested in how do you treat the environment where you are operating. And that's, for them, helps to create a good reputation about your company to them. Okay. If your operations are bad, sometimes they can rebel against you. Okay. They can go for protest and all of that. So community, very, very crucial, very, very important. They might seem as though they are not important, but when they rise, okay, they can also have an adverse effect on how you operate. All right. So these stakeholders are very crucial, and we are saying that there are a number of conflicts that can arise between these different stakeholders. So let's look at some examples of them. Right. So different stakeholders have different interests in the company, and these might be incompatible and will conflict with each other. We are saying that when stakeholders or shareholders have conflicting interests, it is either the company does a number of these two things. It is either there is a compromise which is found so that the interest of each stakeholder group are satisfied partially, but not in full. So let's try to satisfy everybody, right? Or two, the company will act in the interest of the most powerful stakeholder group, right? So that the interest of the other stakeholder groups are ignored. This is very well explained when you are looking at what we call the Mendeley matrix, okay? So that is the power and interest matrix. Okay? So you are saying we have different stakeholders. Some clearly have more power than the others. Especially these people, they have significant power and they can change your company's fortunes. So if they want something and another stakeholder group who do not have so much power also want something, what do? Do you try to satisfy the two of them partially, or you satisfy those who are powerful, right, and have a very high stake within the company and ignore the others who do not have so much to give you in terms of interest and influence? What do you do? Okay, so you take this approach. However, if the stakeholders are all powerful, then you can try to strike a compromise, okay, and satisfy the two of them partially. So these are some of the remedies that you can use as a company when there are conflicting interests. So what are some of the conflicts we are talking about? The government may want to receive tax on the company's profits, which is their interest, right? However, the company, through its runners, who are the directors or managers, will not want to pay a higher amount of tax. If they pay more tax, that means profit is going to reduce. And if profit reduces, it may be seen as if they are not doing well. Okay? And ultimately, if profit reduces, shareholders are not going to also receive the higher dividends that they are looking for. So the company's operators or directors or managers will want to try to minimize the tax liability, their tax liability by using tax avoidance schemes and all of that. Okay, so that will mean that what the government wants, you are not meeting it. Okay, so there'll be some kind of friction. All right. And remember, avoiding tax is not illegal. Okay, it's not illegal. All right, evading tax is rather illegal. So, small conflict here. A company cannot maximize returns to its shareholders if it also seeks to maintain a contented workforce by paying them higher wages. This will be what? A huge amount of expense on your books. And that huge expense is going to eat into your profit. Okay? And so, what do? Do we pay the workers well so that they are content and give up their best for the company? However, that will mean that we are having a huge expense on our books and that will impact on our profits. Or let's pay them averagely, okay, so that we can save money. And once we save money, that money is channeled into other things which will yield more profit for us. And we can pay what our shareholders the returns that they want. So again, there's a conflict. Okay. And again, a company cannot maximize short-term profit if they spend money on environmental protection measures and save what? Water disposal, safe waste disposal measures. You are spending money to be seen as environmentally friendly. That means that in the short term, profit will be what? Will be low. Shareholders may complain. I hope that is clear. So clearly, there is again a conflict between what the community may want and what shareholders may also want. So you can go on and on and on. You can take two stakeholders, and you will see that there will be some form of conflict between what one wants and what the other wants. But we are saying of all of these pairings that we can look at, it is the conflict that exists between the shareholders, okay, and then the directors of the company, not the board specifically, the directors of the company, especially the executive directors and other senior executive managers. That conflict that exists between the two of them is what we are interested in here. Because as we will learn, the executive directors are basically the day-to-day operators or runners of the company, whereas the shareholders are what? The owners. Shareholders want their wealth maximized. Executive directors are also interested in the perks or the benefits that comes with what? Being in position within the company. Okay. So we are saying this whole conflict between the shareholders and the managers gives rise to this theory of agency, right? Or the agency theory, where we are saying the principal, which is the shareholder who has the money, has given the money to the agent, who is the manager, to use the money to what? To run the business and generate return for them. So the agent is going to perform a task on behalf of the principal. However, the agent sometimes loses track of what? Of this core mandate that has been given to it and may want to do something else. And we are saying that is basically what causes what? The conflict. Okay. All right. I'm going to continue shortly. Let me take a pause.